And UIP is based on a lot of assumptions. Some of them are actually quite hard to digest. The first assumption is that you have perfect international capital markets in the sense that you can borrow and lend in different currencies at will. Now, if you take Vietnam, that's probably not completely satisfied, right? Because you have capital controls. And I guess that the government is planning to keep them in place, and probably that's a good idea. Now, the second thing is we have to assume that agents are risk neutral. So they always go for the investment alternative with the highest expected return. Now, you know from your finance classes that that's not what people do, right? I mean, the whole portfolio theory is based on the idea that you look at a combination of assets that offers an optimal combination of risk and return. Risk matters. Now, risk doesn't matter to someone who's risk neutral. That's the important thing. So if we assume, when we write down this, we assume that people are risk neutral, and that is a pretty hard assumption. Now, nevertheless, this condition has made it into most international macro models. I will talk about it later on, how macro has evolved since then. And so I have to know it. Now, let me first make a remark on expectations. Now, the somewhat clumsy notation, which is here, which says this is the expected spot exchange rate in period t+1, is on purpose, right? Because basically, uncovered interest parity should work with any expectations formation mechanisms. How do you form expectations? Well, how do you form expectations about, say, the situation of the Vietnamese economy next year?
You use current or past data.
Yeah.
Information about Vietnam, and then you see you can spot any trend, and then based on that to form our future expectation.
Okay, that's a super answer, because it's something that I will discuss, to put it this way. Now, what you've said is basically you're forming expectations in a backward-looking way. So what you say is, if you have a variable xt and you are here, then what you said basically is you extrapolate the trend and say this is probably where it's going to go, right? So that would be xt plus j, or, well, sorry. That would be x t plus j e for j greater 0. Right? So you basically look backwards, and then you look for a pattern. Now, what's the problem? The problem is the following. Suppose that you get information about, a person becoming a US president that is not a big friend of free trade. Now, Vietnam's economy has benefited big time from being an open economy. And the fact that the American president imposes tariffs on just about everyone implies that this is the the growth path. Or let me introduce some fluctuations. Right? So there will be a major recession, and then Vietnam will grow much slower, at a much slower pace, because of globalization being essentially reduced. Now, what I'm telling you here is that there is a virtue in forming backward-looking expectations, but because you can identify patterns and then you can project them into the future. And for some variables, this works quite well. On the other hand, if you have new information, for example, about a complete change in the pattern of the world economy, then you should put this into your expectations formation mechanism. So then the past is no longer relevant. You should use the information that you have. For example, that was my example, on the trade policy of the US president, to revise your expectations, and maybe you will arrive at that. Now, this is exactly the difference between rational expectations and non-rational expectations. Rational expectations is a very specific form of building expectations. It is, you use all the information that you have and you form a conditional expectation based on that information, which might also include past relationships. But the bottom line is, if you just do backward-looking for expectations formation, then you really, stick to that. Now, in fact, you will see that you're proven wrong, and then you will slowly adjust. In the first moments, you would think, well, that's just an accident, right? And you still keep forming expectations like this, and then eventually you say, maybe something has changed. Now, the rational expectations formation mechanism says every information that we have is included in forming expectations about the future. For example, a change in US trade policy, right? And this is what Robert Lucas made popular in the 1970s, introducing rational expectations into macroeconomics, because before, most macroeconomic models had expectations in them, but backward-looking expectations. So what is your inflation for the future? Well, it's probably last period's inflation, right? That's what people did. And Lucas said, look, this is wrong. It's not, and it's why. What is rational about rational expectations? Well, with rational expectations, you can be wrong, but you're not systematically wrong. If you're forming backward-looking expectations, then for a while, you're just completely out of touch with what's actually happening. And that's the problem. And that's not rational, because you're losing a lot of money. So Lucas introduced rational expectations. And rational expectations is just that, like all the information that you have are used to form expectations about the future, about the past, but about also, and that's the key thing, also about what someone announced about the future, right? That's, now all our macro models, literally all models, with a few exceptions, are built on rational expectations. So Lucas, I mean, the importance of Robert Lucas cannot be overstated. He's probably, for macroeconomics, he's the founding father of modern macroeconomics. And so he justly got the Nobel Prize in 1995 when people said, look, without Lucas, we would be somewhere completely different. Now, currently, things are changing and shifting, and people acknowledge that perhaps rational expectations is too demanding. People just don't get it, right? But for the time being, most macro models are still based on the rational expectations paradigm. So now, importantly, you can postulate UIP without specifying the expectations formation mechanism. So UIP is something, suppose everybody forms expectations built on watching birds or drinking coffee and then looking at the pattern at the bottom of the cup, or asking their relatives then UIP should also hold. So basically, UIP is something that should hold regardless of the expectations formation mechanism. This is important because when people test UIP, uncovered interest rate parity, there's a famous set of regressions that people are running, and which actually do not offer very good news on the empirical support for UIP, but people often argue that this is because they jointly test the hypothesis of rational expectations and UIP. Good. Now, sometime a student asked me, why is uncovered interest parity called uncovered interest parity? Well, what is uncovered about it? Well, it's because you are exposed to risk, right? So with covered interest parity, you have that forward contract that eliminates all exchange rate risk. With uncovered interest parity, you are exposed to exchange rate fluctuations. So you may be lucky, you may be unlucky. Now, if you're risk neutral, you don't care about risk, right? You just care about expected values. That's why things are so simple. But this is not about arbitrage. Arbitrage is risk-free, the exploiting price differences and not incurring any risk. UIP includes some risk, but people just don't care because they're risk neutral. Now, a log approximation of the UIP condition is this. In the same way that we did the log approximation for covered interest rate parity. So we just take logs and then we use this approximation. There is a little catch, which is the log of the expected value is not necessarily the expected value of the log, right? Because you have the log is a concave function. Now let's sweep this under the rug, right? If you read finance textbooks, right, people present this and say, that's the way it is. If you read economics textbooks, people say, we use this approximation, we don't feel very good about it, but we use it nevertheless. Now, importantly, this is a super important message, which says, in equilibrium, the domestic interest rate has to equal the foreign interest rate plus the expected change of the nominal exchange rate. So note, if the expected change is negative, the currency is expected to appreciate. And if the expected change is positive, the domestic currency is expected to depreciate. Here's a bug. Sorry about that. I'm not allowed to write on this, but please insert domestic, right? It's the domestic currency because, there's two currencies, so which currency are we talking about? So if the expected change is negative, the domestic currency is expected to appreciate. So home country's currency. So I'm trying to correct that. All right, 655. Good. Now, let's do some examples. Just to, this is not rocket science, but suppose that ITH equals 2%, and ITF offers an interest rate of 5%. Right? So if you put your money into euro assets, you get 2%. If you put your money into dollar assets, you get 5%. So what is the implied value for this? Right? So and exactly? -3%. Yep. So now what's the logic? Now, if this change is negative, do people expect the domestic currency to appreciate or to depreciate? Right. So the next. Of domestic currency by 3%. So what's the point? Well, you have one asset that offers 2%. You have another asset that offers 5%. So why the heck shouldn't people put all their money into this asset? Because they're getting a higher interest. Well, the reason is because that currency becomes more expensive. So there's an exchange rate. There's an exchange rate gain, right? So conversely, I mean, let's do another example. Suppose that the domestic currency offers an interest rate of 7%, the foreign interest rate offers, the foreign currency offers an interest rate of 2%. So what is the implied value for ET plus 1, E minus ET? 5%. So what does that mean? Is the domestic currency expected to appreciate or to depreciate? Right, so that's an expected depreciation of domestic currency by 5%. Now, if you put your money into this thing, you get 7%, but you betting on a currency that's getting cheaper, that loses value. So the reason why people are willing to hold this is because this is the thing that, in bilateral terms, is expected to appreciate. So the foreign currency is expected to appreciate. This is why people are holding this. Now, one more thing. Sometimes we see interest rate differences even for fixed exchange rates. Now, then this may have two pieces of information. Firstly, the fixed exchange rate is expected to break down. Second explanation, these assets are not perfect substitutes because one asset has a higher default risk. So when you put your money into an Argentinian government bond, you have to be very, cool-minded because you shouldn't be too nervous because Argentina has defaulted on its debt over and over again. They may do it again, right? So, but just to highlight, your uncovered interest parity is based on the assumption of perfect capital mobility, so there are no frictions. Everything's running smoothly, right? If you borrow money, you pay it back. If you lend money, you get it back. So it's not just risk neutrality, it's also perfectly functioning financial markets. No default risk. People don't even think about it. Okay. Good. Now, when I was a student, I was very confused at some point because I had professors telling me two stories, sometimes different professors in different classes at different points in time about what's going on in the foreign exchange market. What do I mean? I mean this. Didn't I tell you about this stuff? Right? That's what we did yesterday. So you have current account driven demand and supply of currency, you have financial account driven demand and supply of foreign currency. And the question is, how does uncovered interest rate parity relate to that? And the answer is, uncovered interest parity basically makes a very strong statement about what really matters on foreign exchange markets. Right? So keep that picture in mind. Uncovered interest parity says there's perfect capital mobility, risk neutrality, assets are perfect substitutes, and we have very large financial markets. And as a result, current account and capital account transactions do not matter for the value of the nominal exchange rate that clears the Forex market. So that was conventional wisdom for decades and decades, that people said, well, you know, maybe people buy Swiss francs because they want to buy Swiss chocolate. And people buy Vietnamese dong because they want to buy Vietnamese mangoes. But that's just peanuts compared to the magnitudes involved in financial markets. So why do people buy Swiss francs? Well, because they want to open Swiss bank accounts. Why do people buy US dollars? Because they want to buy US assets. Why do people buy Vietnamese dong? Because they want to invest on the Vietnamese financial market, right? This is what's driving what's going on financial markets, what's going on foreign exchange market. And these people have a point. Now, this is a graph that shows you the exports of goods and services, billions of current US dollars, up to the year 2021. Now, in 2021, the global exports of goods and services amounted to something like 27,000 billions of US dollars. That's a lot, right? This is the scale of global trade. So these are trade transactions, trading goods and services. Now, this is the worldwide turnover in foreign exchange markets. And you see in 2022, that was something like $7,500 billion per day. Right? So multiply 7,500 by something like 250. Maybe you can multiply it by 365 because the foreign exchange market never sleeps. So multiply 7,500 by 365 and you get activity on the foreign exchange market that dwarfs what's going on in goods markets and services markets. Whew. Right, so people are trading a lot across borders, but they're trading currencies by orders of magnitude more. Conclusion is, people are not buying Swiss francs because they want to buy Swiss cheese or Swiss chocolate. People are not buying Vietnamese dong because they want to buy Vietnamese mangoes or Vietnamese manufacturers. People are not buying euros because they want to buy European cars. It's all about financial markets. Now, so the current account doesn't matter. It's just like a drop in the sea. It's something that, you know, forget about it. Now, and the picture characterizing foreign exchange market equilibrium is not the picture that I showed you, but it's this picture. The current account is just here, right? It is driven, of course, by the nominal exchange rate. But the nominal exchange rate is pinned down by this condition. End of story. This is just uncovered interest parity. Right? We have ITH equals 1 plus ITF, ET plus 1E over ET. And then we just rephrase that as ET equals ITF over 1 ITH times ET plus 1E. That's it, right? So what is driving nominal exchange rates? Not whether people want to buy, not whether people want to take a vacation in Turkey or want to buy a German car. It's really just interest rates and expectations about the future. Now here, this is the next important thing. That's why it gets a red frame. Now, this is today's nominal exchange rate. So if 1 plus IETF goes up, what happens to the nominal exchange rate? It depreciates, it goes up. So that makes sense. If the foreign interest rate goes up, ceteris paribus, everything else staying constant, then foreign assets are more attractive and people put more money into the foreign currency. What happens if the domestic interest rate goes up? It's going down, so there's an appreciation of the domestic currency. So far, so good. So that's basically what we observe in foreign exchange markets. When European interest rates go up, then usually the euro appreciates. When the European interest rates go down, then the euro depreciates. Now, the last thing, and that's the most important thing, what happens if people expect the future spot exchange rate to be higher? Exactly right. So ET goes up as well. And this, believe it or not, this is probably the most important insight of this morning. Uncovered interest parity suggests that it's not things that we observe that is driving the nominal exchange rate, but also things that we expect to observe. So if people revise their expectations about the future spot exchange rate, that has an effect on the current spot exchange rate. And that is something that we will go deeper into. So if people expect if ET plus 1E goes up, that has a direct effect on today's exchange rate. Now, is that surprising? Well, the answer is not totally, because foreign exchange markets are financial markets. What matters on financial markets? It's expectations. Right? What matters for the stock price of a firm? It is how you perceive the future of that firm. So there we have tons of examples where we have firms that are making losses, and still the price of these firms, the stock price of these firms, is high because people think that the firm has a bright future, and they want to buy. They want to participate. So we have a similar phenomenon on foreign exchange markets. Now we're talking not about stock prices, we're talking about currency prices, and we see that expectations about the future matter for what's happening today. Okay, now I've said a lot of bad things about the picture I showed you yesterday. You know, remember Turkey, right? Current account. I will come back to that. The literature is currently, and I'm not talking about the past 50 years, I'm talking about papers being published in the last 10 years or so. We're moving away a little bit from the straitjacket of uncovered interest rate parity, right? So there's an exciting, there's a lot of things going on in research on foreign exchange markets, and people acknowledge that maybe UIP may be too simplistic. But for the time being, the great thing about let's stick to UIP, and let's distill out of UIP this very important message, namely that the future matters for what's going on in the present period. And this is the essence of the monetary model of the exchange rate. And the monetary model is what I want to do with you in the next half hour. It will be sufficient. So let's roll up our sleeves and go into the monetary model. The monetary model of the exchange rate is like, you know, it's like what Hamlet is for English literature, right? Shakespeare. Or what Goethe is for German literature. Do you know who Goethe was? Okay, that's important because maybe you pronounce it differently. The Americans certainly pronounce it differently. Sorry, let me do a brief digression. Now,